into your questions. Libre à vous de poser vos questions dans la langue officielle de votre choix. Just please use the microphone in front of you by pushing the button on the top and waiting for the green light. We'll do a quick one question and a follow-up in this first round. Just indicate to me if you'd like to ask a question, and if I don't do it for you, just state your name and affiliation. At this point, I'll turn it over to Senior Deputy Governor Wilkins for her opening remarks.
Good morning. Governor Politz and I are pleased to be here to answer your questions about today's interest rate announcement and our monetary policy report. The Canadian economy is operating close to its potential level of activity, and inflation is close to the 2% target. In this context, the Governing Council decided to raise the policy interest rate by 1/4 of a percentage point to 1.25%. The data that we have received since last October have been generally stronger than expected. Growth around the world continues to strengthen and broaden, supporting the expansion here at home. We have upgraded our outlook for the U.S. economy due to greater momentum and the new tax legislation passed last year. In Canada, economic growth is expected to average around 2.5% in the short term before slowing to a more sustainable pace over the projection horizon. This outlook remains clouded by uncertainty related to the future of NAFTA. In coming to our decision, there were 3 issues that Governing Council spent a lot of time discussing, and I'd like to walk you through them. Le premier enjeu était relié à la marge de capacité excédentaire qui subsiste dans l'économie et à la façon qu'elle évoluera. De toute évidence, cette question est toujours importante pour une banque centrale qui vise une cible d'inflation. Mais elle est particulièrement importante à cette étape du cycle économique. En octobre, nous avons indiqué qu'on observait encore des signes de ressources inutilisées sur le marché du travail. Nous avons aussi mentionné que même si nous estimions que l'économie tournait presque à plein régime, il était possible que des capacités accrues soient créées avec le temps. Et ce, grâce aux investissements des entreprises et à une augmentation de la participation au marché du travail. The data that we have seen suggests that labor market slack has indeed been narrowing, and somewhat more quickly than we had expected. The national unemployment rate has fallen to historic lows, average hours worked are recovering, and our business outlook survey points to signs of more intense labor shortages. That said, wage pressures remain modest. Now, this could indicate that some capacity remains in the labor market. It could also indicate that wages have become less sensitive to pressure in the labor market, given the impact of global competition. Either way, wages do not appear to be a source of inflation pressure at this point. We published a staff analytical note today about wages, and will continue to monitor this issue. En ce qui a trait à la création des capacités, nous avons également observé des signes positifs. Les investissements des entreprises ont continué de croître. L'enquête de la Banque sur les perspectives des entreprises montre que les intentions demeurent positives. Et les révisions apportées aux données historiques montrent que les capacités sont plus importantes que nous le pensions. Les nouvelles entreprises sont généralement une source essentielle de croissance de capacité, et bien qu'il soit encore trop tôt pour dégager une tendance, les données récentes sur la création d'entreprises sont encourageantes. Nous mettrons à jour notre point de vue sur le potentiel de l'économie dans notre RPM d'avril. The second issue was how the evolution of capacity pressures will affect the outlook for inflation. As the governor noted in a speech last November, a number of economists and policymakers have been struggling to explain weaker than expected inflation in many jurisdictions. This has not been the case here in Canada, where core inflation measures have been increasing and behaving largely as we would have expected. Inflation was actually a bit stronger than we projected in October, rising to just above our 2% target near the end of last year. Now, this was due to temporary impacts of higher energy prices. We expect a bit of a dip in inflation in the near term, largely because of base year effects on gasoline prices. The big picture is that we project inflation to fluctuate relatively close to the 2% target throughout the projection horizon. That said, there are still risks that a drag on inflation coming from global trends could occur. The global trends could be those such as digitalization in the economy, and this will continue to be something that we watch closely. The final key issue we discussed is how best to account for the uncertainty surrounding the renegotiation of NAFTA in our policy decisions. Where trade policy decisions have already been taken, such as the case with softwood lumber, we have built this into our expected effects. In addition, while the Business Outlook survey results were positive, an increasing number of firms told us that uncertainty surrounding the outcome of the talks is weighing on their investment decisions and, to a lesser extent, trade. Because of this, we have added some more negative judgment on our profile for both business investment and exports. Now, consistent with this approach, our outlook is based on the premise that current trade agreements will be in place over the projection horizon. There are still a wide range of possible outcomes, which could play out over many different timelines. We don't know yet how the talks will conclude, and we don't know how governments will react to whatever outcome is reached. This means that trying to quantify any particular scenario would not be useful at this point, for monetary policy purposes. Toutefois, le personnel de la Banque s'est attaché à déterminer les canaux par lesquels notre économie pourrait être touchée par les changements aux politiques du commerce extérieur. Cette démarche est subtile. La théorie économique nous enseigne que l'inflation peut subir à la fois des pressions à la hausse et à la baisse. Et ce, parce que les changements apportés aux politiques du commerce extérieur peuvent se transmettre par ces canaux multiples qui touchent tant à la demande qu'à l'offre dans l'économie avec le temps. De tels changements peuvent aussi avoir un effet sur les prix des actifs et le taux de change. Quel que soit l'issue, nous serons prêts à évaluer les effets à mesure qu'ils se manifesteront et à s'ajuster la politique monétaire à point nommé si nécessaire. Compte tenu de tous ces enjeux, bien que l'on s'attende à ce que les perspectives économiques justifient des taux d'intérêt plus élevés avec le temps, il sera probablement nécessaire de maintenir un certain degré de détente monétaire afin que l'économie continue de tourner près de son potentiel et que l'inflation demeure à la cible. Continued stimulus is likely to be required for a time to take into account a number of factors. They include the effects of uncertainty related to trade negotiations, the expected effects of recent adjustments to mortgage lending policies, and greater sensitivity of the economy to interest rates given high household indebtedness. In this context, raising the policy rate too quickly would risk stalling the expansion and cause inflation to fall back below target. At the same time, raising the policy rate too slowly would risk a buildup of inflation pressures. Governing Council will therefore remain cautious in considering future policy adjustments, guided by incoming data in assessing the economy's sensitivity to interest rates, the evolution of economic capacity, and the dynamics of both wage growth and inflation. So with that, Governor Politz and I would be very happy to answer your questions.
Great, thank you very much. We'll get started. Again, a question and a follow-up. But first on my list, I've got Paul Vieira from Wall Street Journal, followed by Greg Quinn from Bloomberg.
Will rate policy now be dictated by the flow of NAFTA negotiations or incoming data?
Right, wow,
Just don't get good help around here, do we?
I know. We do, but I can't remember all those things. So, sorry about that. We remain fully data dependent for the reasons we've described before. It is this list of issues which are important unknowns at this particular juncture. Nothing mechanical, is appropriate at this stage. And so data dependence is illustrated very aptly today, I would say. You saw the flow of good data coming the last few months, certainly since last September, October. And so you saw those data kind of make their way through the marketplace. The markets embraced the positive data. Longer term yields gradually edged their way higher. And today what you do is you get a rate hike which basically validates what we've seen in the marketplace. That's how data dependence tends to look on average. And so in terms of NAFTA, of course, as just said, it's a very big unknown for us. And it's not just unknown what is happening, but it's unknown what it will look like and how its effects will work their way through the various channels that Ms. Wilkins just mentioned. So there's no unambiguous pre-calculation one can do about how it would affect the economy. It's more a case of being prepared to know which dynamics to watch for and to be able to respond in real time in an appropriate way. We've put most of our emphasis so far on the investment channel. That's a little bit on trade, but mostly it's the investment channel, which we think is what is being mentioned most to us in our discussions with companies. And it's a channel that has not been actually analyzed in other studies that you've seen. It's mostly about how is trade affected by trade agreements and their removal. But underneath that is the strategic decisions of companies, and that's where we've actually seen, we think, effects already, even though the agreement is exactly as it always was. So that's just stays as an unknown, and I'm afraid that data dependence remains the watchword. There's nothing preset or mechanical going on here.
Are you, how long, when the bank says some continued monetary policy accommodation, what does some mean? And I guess is my basic question.
So some means the same as it means in everyday language. It just means some. And we use the word some because, frankly, we can't be precise about it, and we wouldn't be precise given all the unknowns that we face anyway. But to put benchmarks around it, you can see in there that our forecast is built on an assumption that the neutral rate of interest is somewhere between 2.5 and 3.5%. That's a real rate of interest of 0.5% to 1.5%, layered on top of a 2% inflation target, which converts to nominal, 2.5 to 3.5. And today we are at 1.25. So by that, you can gauge how much stimulus is estimated to be in the system at this stage. If the economy were completely back to normal and all the forces acting on it had dissipated, arguably somewhere in the neutral rate zone is where interest rates would end up. But there's a number of things still acting on the economy, which mean that it's going to be some time before we could get there. And it was throughout that period, some accommodation will still be required in order to offset those things and keep the economy in this zone, which is, close to potential and with inflation close to target. And so the things are, as Wilkins just mentioned, some of them, there's several things that one could name. I mean, one that I'd like to remind you of is the persistent decline or erosion in our competitiveness that we've observed. That is to say, although exports are in an uptrend and have been for some time, we know, given what we've been through the last three years or so, that exports in level terms are well below where they would have been, what our models told us, before all this. And, we traced that back to, capacity that got, that exited the marketplace. We did a lot of analysis on those things, and a trend loss of competitiveness. So this is a headwind, if you like, or a gap between where we are and where full equilibrium, where the neutral rate applies. So that's one good illustration of what I mean as a headwind. And I've said before, you're riding a bicycle up a hill. How steep is the hill? We have to keep gauging it on a continuous basis.
Thanks. We'll go to Greg Quinn from Bloomberg next, and then I've got Kevin Carmichael from the National Post after that.
Good morning. You mentioned the drag from the uncertainty over NAFTA talks. Is it your view that there's some permanent or long-term damage to Canada's economy just from this uncertainty? In other words, if it's renegotiated relatively quickly even this year, can we jump back to where we were before?
So what we hear from firms when we talk to them through our survey, and also just in the normal conversations that we have with businesses across the country, certainly the negotiations are top of mind. And so when they're thinking about renewing investment mandates or production mandates, and we've seen that with some large companies recently, they face a decision about whether or not it's just safer, given the uncertainty, to just do the investment in the U.S. And that's on top of previously thinking that maybe for competitiveness reasons there were arguments for that as well. And so that's the reason why we've taken it on board. Certainly, businesses aren't saying they're not going to invest at all in Canada. They're the expectations are quite robust, but they're less robust than they would have been otherwise. And so that means there's capacity here that isn't being built. And so that means potential is lower than it would have been otherwise, which is a longer term thing. Could it be made up in the future through some other channel? Well, that remains to be seen. But certainly those are the effects we're seeing, and the tax changes in the U.S. as well are another factor that makes us more cautious about business investment in Canada going forward.
Secondly, there are some economists who have suggested that the expansions in Canada and the U.S. are quite long already, and central banks need to prepare themselves for the next downturn or recession. At the pace you're going, will you have enough ammunition to deal with whatever slowdown comes in the future?
Well, yeah. I mean, I know that there's one school of thought out there that expansions die of old age. But I think, in fact, very few of them ever have. They die because something else comes along to disturb things, and one of them is inflation pressures, for example. So central banks see inflation pressures and then put on the brakes, and that causes a slowdown or perhaps a recession. But most of the others are just some exogenous thing that happens that throws the world or the domestic economy off course. So take, for instance, if everything had been perfect the day before the oil price collapse back in 2014, I mean, we would have had, a pretty big slowdown there. The fact that it happened in a slow economy made it doubly difficult to work with. But that's about nothing that happened in Canada that caused that. And so we need to be prepared for a new shock. And one of the things that we've talked about a lot in the context of the FSR is that our vulnerability to such shocks has grown through this cycle. So the stock of debt in particular means that those vulnerabilities that are there mean that any shock that happens is likely to be magnified in its effect on the economy. So some of the macroprudential moves that have been made are intended to make the economy more resilient to those kinds of shocks. So that's an important ingredient to the answer to your question, that I think our resilience is improving on that front. Secondly, our experience over these years has illustrated in practical terms how negative interest rates can operate and in fact, foster expansions when, zero rates of interest weren't. And so that's a learning for the entire profession, and it's enabled us to think about, when we did the renewal for the 2% inflation target, we thought carefully about whether we had sufficient room to maneuver in future business cycles. So all that being said, yes, obviously today we have more room to maneuver in that respect than we did a year ago, which is good. And so I think with the economy in such good health as it is, we can be confident that we continue to build on this.
Great. I've got 10 or so folks on the list, so I'll get through to you. But next is Kevin Carmichael from the National Post, and then I've got Karina Roman from CBC after that.
I have a question about the U.S. tax changes. A superficial analysis of those might simply result in the conclusion that Canadian and U.S. rates are now roughly the same. I know it's not simple as that, which is why I'd like you, if you could, to share a bit more of your analysis of those changes. What is it specifically about the U.S. tax overhaul that makes you think that they're going to sort of exacerbate this potential trend of more investment being diverted to the U.S. that might otherwise have ended up in Canada?
It's true that the reduction in the federal corporate rate is bringing things more in line. It still is a change down, though, so that headwind, the reason it was sticking in Canada is kind of gone. But there's another thing that I think is quite important as well, and that's the bonus depreciation part, which changes the economics of it as well. There's an offset to the corporate tax rate that maybe for some sectors, means that it's not as good as it looks in the U.S., and that's the interest rate deductibility limits. But again, that's kind of a detailed sectoral thing. And as I said earlier, when you look at sort of at the margin, that's a positive for investing in the U.S. on top of some other ones that businesses were already seeing in terms of their own risk management. And so because of that, and because of what we heard in the latest Business Outlook survey, it seemed that was becoming even more top of mind. We increased the negative judgment on our investment profile. It's still rising, but it's rising less than it would have otherwise.
And my second question is on Canadian wage gains. As you've noted, they've creeped up over the last couple of months, I guess around 2.7% in the most recent numbers. That's roughly the average of the last couple of decades. And of course, this follows a period of relative stagnation for the last year. So two short questions in this one question. What sort of rate of wage gain does the bank consider as sort of normal, or what would you like to achieve, or what would make you comfortable? And how long do you feel a need to have a period of extended increases to make up for this period of stagnation that we've just gone through?
So we have seen wage growth pick up a bit, and you might have noticed that there are a number of sources of wage growth, and they can send different signals, and so it's important to look at them all. There is not one rate of growth in wages that in fact would make us comfortable, because there isn't one rate that gives kind of a neutral effect on inflation. It depends on a number of other factors, including, and probably most importantly, productivity growth. So if productivity growth is high, labor productivity growth is high, well, wage growth should be a bit higher as well. And the opposite is true. One way we've worked to disentangle this in a more structured way than just looking at month-to-month variations that can be volatile is to try to find a common measure using the 4 measures that we have that really does a good job of tracking and being highly correlated with the fundamentals as we see them. By that I mean what we think the labor gap is and what we think the output gap is. And the staff analytical note that we published today by Danny Bruyette and his colleagues is pretty innovative, because what it does is it takes, and this may sound technical, but it's pretty important. It takes the labor force survey data plus the staff and the national accounts, there's another set of accounts, and basically creates a common measure, common trend, and finds that in fact that common measure does a pretty good job of tracking what we think are fundamentals. And what you see when you look at that is you can explain some of the pickup in wage inflation by the fundamentals. And so it does confirm that the gaps are narrowing. They're not quite closed yet. It obviously operates with a lag, but it's certainly moving forward is a very organized way for us to track what's happening in the labor market and what's also happening with wages, because it's there. It's one of the places you look for pressures, future pressures on inflation. It's not the only place, but it's one place.
If I could just add one little thing, and that is that common measure suggests that wages are running at around 2.2%. And one of the measures you mentioned is higher, which is fair. So around 2.2%, which is roughly in line with inflation. So it suggests you have no actual real wage growth yet. And despite the fact that actually productivity has been doing reasonably well. I mean, it's volatile, of course, and especially if distorted by the oil price shock and the recovery. But productivity has actually been pretty positive on average through this, and that suggests, therefore, that there's room in there for wages to continue to gather more momentum, and that's an important signal to those. The rest of our story is that we'll see increased re-engagement with the workforce, and importantly, underneath that, more shuffling, so you get the stronger matching of skills with jobs. You get a productivity lift from this also. That entire process is usually a function of an economy that's running at the top of its game and wages are rising to actually encourage people to make those switches and move up to the job that matches their skill set, or move from part-time to full-time. And all those kinds of transitions are a function of the life in the wage space. And it doesn't happen while wages are stagnant, as you mentioned before. So it's all encouraging. It's one of the ingredients we need to see. And so we're happy about it. But it's, as Carol said, it's not over.
Okay, I've got Karina Roman from CBC Next. Et après ça, Mylène Crête, Presse Canadienne. And still a few to go.
You've said in the past recently that one of the factors in our growing economy is the government measures, such as the child benefit and recent indexation of that child benefit. Now, raising the rate today means some of those people who are benefiting from those measures will pay more for their mortgages or on their debt. And I wonder, do you not have any concern that the raise of rate today sort of undoes some of what actually got us to this point in the first place?
I don't think of it in those little, segments like that. I think of it as a full package. And, if we go back through what we've been through, the long period of no or slow growth and exceptionally low interest rates, we know that exceptionally low interest rates, they do their job, but they also create side effects that we monitor carefully in the FSR. Vulnerabilities, et cetera. And that throughout that period, it would have been preferable if we'd had a different mix of policies where perhaps we had a little bit more fiscal impetus and a little less coming from interest rates. Now today, we're in a better mix than we were 2 years ago. So I think that's unambiguously a positive change. But of course, if you decompose all that into the segments as you just did, you can pick one piece and say that's going to affect people negatively while this piece affects people positively. It's not at all how we would think of it. Everybody's better off with a stronger economy. Stronger economy means that interest rates can move a little closer to something more normal in a context in which everybody's better off. And so that's the combination that emerges.
And so I know you talked about how, no one's ready to take their foot off the pedal yet, whether it's fiscally or from a monetary point of view. But, there is some concern that if the economy is strong and we are now at a point where we can raise interest rates a few times in recent months, do you think it's wise that the government continue with stimulus measures that are funded with deficit spending? Is that something that should keep happening considering where we're at in the economy?
Well, I'm not going to comment on the government's plans or their actual fiscal policy, but I would remind you that we would still have a sizable output gap in the economy were it not for the fiscal actions that have been taken over these last 2 years. Somewhere in the order of 0.5 of a percentage point, which is significant. And so it is that fiscal expansion which has helped bring us to this point where we can have, let's say, a healthier profile for interest rates than what we had when they were rock bottom. So there's a lot of positives associated with that, and to the extent that it's the fiscal policies aimed at improving our infrastructure, which is really an investment as opposed to spending in the classic sense. Just as a business borrows to buy new machinery or equipment in order to expand their business and make it more efficient. I don't think there's a complete parallel there with the government borrowing in order to improve our infrastructure, which is something we all use every day to be more productive and make the economy work better. So when we talk about the trend line of the economy being around 1.5 or 1.6% for potential growth, the kinds of ingredients that will help cause that thing to tick up to 1.7 or 1.8 or 1.9, each of which would mean, more growth like forever, more or less, like accumulates to a lot of income for the economy. It's ingredients like infrastructure or trade agreements or interprovincial trade agreements or things that add to the ability of the economy to perform. And so some of these things are worth actually borrowing for.
Okay, Mylène Crête next, and after that we've got Raoul Vaidyarat from EPA.
J'aimerais vous entendre en français sur l'impact de l'incertitude causée par la renégociation de l'ALENA sur vos prévisions aujourd'hui.
Okay.
Oui, en ce moment, ce qu'on voit avec l'incertitude qui entoure l'ALENA est vraiment un effet sur les investissements chez les entreprises canadiennes. Ce qu'on entend dans nos survols et nos conversations qu'on a souvent avec les entreprises est que quand ils font face à une décision, est-ce que j'investis au Canada ou est-ce que j'investis aux États-Unis? Ça semble des fois plus simple et mieux gérer les risques d'investir aux États-Unis. Et c'est sûr que ce n'est pas toutes les entreprises et tous les investissements qui vont au sud de la frontière, mais quand même, ça nous a amené à mettre du jugement à la baisse sur notre profil d'investissement. Alors, l'investissement va augmenter à travers la projection, la période de la projection, mais moins que ça aurait fait autrement. Alors, tant que l'incertitude persiste, on croit que probablement l'effet va persister, sur l'investissement va persister aussi.
Source d'inquiétude?
Je crois que les entreprises sont variées. Ça dépend s'ils sont des exportateurs ou qui utilisent l'ALENA ou s'ils sont des compagnies qui sont aussi diversifiées dans d'autres parties du monde ou qui ont un profil plus domestique. Alors, ça varie, mais parmi les institutions qui dépendent de NAFTA ou qui profitent de NAFTA, c'est sûr que c'est une source d'incertitude et puis parmi d'autres.
Okay, Raul?
Yes, good morning. With respect to exports, the behavior is obviously very volatile and like as seen in the third quarter. But do you start to have a better idea of how much of a contribution it should be making to the economy when it's in equilibrium, or is it still very difficult to tell given its volatility, and it seems to disappoint from time to time?
Well, I mean, it's an easy question and a hard question, so thanks. But anyway, but it is the real answer is we can't be sure of this because there's big structural changes happening within the economy. And in fact, we had to get our arms wrapped around those back in 2013, 2014, because we started to pick up on the fact that things weren't responding in the usual way to, a lower dollar and so on. And when we got into the 2000 export categories kind of level of data, what we discovered was that a bunch of those categories had disappeared. So the actual, and then you could correlate that with actual media coverage showing, oh, this plant is closed and so on. So you start to accumulate that. And that explained a big piece of our forecast error in that period. So that's okay, explaining an error, but then ask, what does it really mean? Well, it means that Canada has lost that capacity to export from those areas. And then I gave a speech on this, seems to me it was in Toronto, but I may have at the CDL, maybe, I've forgotten anyway, but which dug down into this. And the idea was to say, well, what can replace it? So what have we got that are categories that are new and different? And there are quite a lot of those. And so, and some of them, they can grow, basically their limits to growth are basically around people because they're highly service oriented. So IT services is one of our hottest employment growth categories and export growth categories. And that is only, the limit on that is not about plant or machinery or so on, it's just about people, right? And so that, as long as that continues to get fueled by good graduates from our universities and immigration programs, et cetera, that's going to be a big growth category. So that gives us a lot of reason to think that structural change, we're seeing the positive end or positive half of that switch. And that's just one illustration. And there are other categories like that, such as the food business. Okay, so the food business has grown a lot in its processed, export-oriented food, as well as more basic food exports. So these are things that we should be encouraged about, and we shouldn't get out of shape about them. And now what happens if we set aside cars, where there's been some big structural changes, which we're all aware of, if we pull cars out, then we can see much more evidence of that uptrend. And of course, as you say, interrupted by the third quarter for various odd reasons, which we thought were temporary, and it's proving to be the case. So on balance, I'm encouraged by it, but where it all ends is really hard. That's the hard part of your question. What we think is it's just going to continue to grow with the fundamentals, and I think that is a fairly conservative forecast. That is to say, there's lots of things that you see that could have sort of that leap forward when the time comes. But we'll never assume those things. We're going to watch for them to happen first.
And just like with respect to NAFTA, in terms of the various scenarios, I mean, just do you see it kind of as a binary event where if the U.S. withdraws, that that could materially change the that trend for exports, even though you may have a weaker currency to support that?
Yeah. So yeah, I don't see it as a binary event, as the term you used. A little history is worth paying attention to. I was around for the analysis of how will NAFTA affect us, and it was at the time really hard to predict how NAFTA would affect us, which is why, of course, such a vigorous debate emerged. usually the debate emerges is among those who perceive that they're going to lose protection and will be harmed by a trade agreement, and others who see it as an opportunity. So you get a debate between those, but this was a genuine debate between, let's say, academic to academic. Will it be good? Will it be not good? And of course, many of us had the fundamental belief that trade is good. So if you can have more of it, it's going to work out. And so if you went back and read some of those analyses, you know, they would, it's amazing how far off some of them were. But of course, it's all genuine analysis is the best you can do. So it's just as hard today for someone to say that if you removed it, who's it going to hurt? How bad is it? You know, I would believe that it would be net negative for both Canada and for the United States. But to actually quantify that is very difficult because every sector is affected differently. It goes from firm to firm, in fact, how they would choose their strategy around that. And so we've chosen not to get buried in all of that and instead to focus on, well, what is the bigger thing that firms are talking about? Because trade would go on. It would be changed in some ways, but perhaps not as deeply as I think there's a lot of investment in the current trade structure. And it may be a very slow process, and that's what we can think of as a supply shock to the economy, because like losing capacity or gaining other capacity. But the channel which seems most immediate and most likely to be observed is this investment channel that you've mentioned a couple of times this morning. So that means that that's actually happening today. Investments either being postponed or diverted to the United States. And that's the sort of effect that could be bigger if, you know, in a binary sense, if an announcement is made that NAFTA is no longer to be. But again, even then it would take time, and it would be something that we could, watch for the implications for the economy and reformulate monetary policy as it goes along. We don't have to figure it all out in advance.
All right, I'm just conscious of time. We've got about 10 minutes left. I want to make sure at least every organization gets an opportunity. So what I've got up next, Yali Nadai from MNI, and then David Aiken from Global, and Reuters after that.
Thank you. I wanted to ask, since the Canadian and the U.S. economic cycles are more in sync, does that mean your policy is more closely tied to the Fed?
Well, short answer, no. But it's true that the big divergence between our economies was during the oil price shock, the terms of trade shock that we went through. And we said at the time this is the classic reason why economies choose to have flexible exchange rates. When there's a shock that causes our economy to be affected much differently from the U.S. economy. And in this case, the collapse in oil prices was net positive for the U.S. economy, and of course a very big negative for our economy. So the divergence was very significant. And indeed, that year we cut interest rates twice, and the U.S. raised interest rates. So that's pretty divergent in terms of policies. Now that the oil shock is behind us, of course, it's true what you say that the economies are more in sync, or at least in the same side of the business cycle. But because of that oil price shock, even though we were more or less in sync, say 3 years ago, just before the oil price shock, we went unsynced, or we went uncorrelated for that time, and we're closer into the same phase of the business cycle. But we've had about a 2-year setback in terms of that process. During those 2 years, while we were dealing with the downside from the oil price shock, the U.S. economy was continuing, to build its momentum and to use up excess capacity. Indeed, or arguably over the last 18 months or so, the U.S. has pulled new capacity into the economy from previously discouraged workers or those who had dropped out of the workforce have re-entered. And that is exactly the kind of phenomena we're watching to happen here in Canada. And we're seeing early stages of it. And so I think we're still, although we're in, as I said, we're both in a clear expansion phase. we are behind them in that cyclical sense to some degree. And again, there's some uncertainty around it. But most importantly is that our inflation target is our inflation target, and that's what we care about. That's what we will analyze, and that's how we'll formulate our policies. And as the Fed does their thing, we of course need to take their moves into account in our forecast. But that's not the same as following them.
And the second question is, well, I know you said you don't want to, predict. It's impossible to predict what's going to happen with the NAFTA renegotiations. Yes. But in the current economic environment, if there was a collapse of NAFTA, is that a shock big enough to warrant the end of tightening in and of itself?
So, no, the real answer to that question is that we don't know. We really are not in a position to do a pre-analysis of how large that shock might be. There are scenarios that people are playing with various kinds of models, which are informative. They do suggest that on using just the trade consequences, okay, trade models, that it doesn't seem to be that large of a shock to the economy, and one that would be a bit gradual. And so that of course fits most people's intuition anyway. But I caution you that what people are analyzing there usually is a move from NAFTA tariff rates, in other words, mostly zeros, to WTO tariff rates, most favored nation system, et cetera. And that's a useful exercise, but I'm certainly not willing to say that's what the shock that we should be thinking about. Because, the administration may wish to do other things in the trade space which are more significant, such as is happening with softwood lumber or with airplanes or stuff like this. So we can't just relax and assume it would be a small shock. And furthermore, the analyses that you're looking at do not consider the channel that I'm trying to emphasize the most, which is what are the consequences for long-term investment in Canada. And that is the channel that we have built in to our analysis, into our forecast, which is if NAFTA all gets cleared up, then there would be, I think, a boost to investment based on what companies are telling us, because they're postponing or not investing. They're growing their investments, but less than they would if they knew what NAFTA was going to look like. And so in that context, then that channel could be much more significant than the trade adjustments that we're talking about. And that's why it's important for us to monitor it carefully and continue to talk to companies about how they're feeling about it. Did you want to add anything to that?
That was a great answer. There's one aspect. No, it's really just adding to it. I think that investments is the main channel. The thing that's on my mind as well is what happens to supply chains. And the development of global supply chains and that's part of the thing we couldn't tell when we were trying to figure out what would happen when NAFTA came in place. That was a big boost. Otherwise, productivity, even though it hasn't been stellar, productivity growth would have been probably lower without the rise of global supply chains and better ways of doing things, making partnerships with other countries in different parts of your production process to be more efficient and more cost efficient as well. And when you start to untangle those, and those are very, very tight between Canada and the U.S., then you not only have implications for investment, you could have implications for productivity growth as well, which is another supply issue. And it certainly, would be an unfortunate one, because that's what leads to potential output growth and rising living standards over the long run.
All right, I think we've got just time for David Aitken and then Reuters, and I think that'll be it.
It's been interesting to hear you talk about your concerns about investment, but I wondered, let's imagine a world where there's no NAFTA and whether it's returned to to WTO tariffs or some other tariff arrangement. Could you speak about the effect of that on consumer prices and business profits?
Well, as I indicated a minute ago, it varies a lot from sector to sector, and then the response is behavioral. There's nothing mechanical about it. I think on your first part of your question is pretty unambiguous that consumer pricing goes up. That would, I think, any model I can think of would tell us that. And in fact, when we move from a regime of managed trade or restrictive trade to a free trade agreement, the clearest part of that analysis is what economists call the income effect, which is the price of just about everything on both sides of the border goes down because the trade agreement creates those efficiencies. That decline means that everybody on both sides of the border has more purchasing power. So most of the heat that happens in the debate is about, well, this is going to be bad for this sector in one country, but good for that sector in the other country, and vice versa. And does it add up? And how does it add up? Which is a really, really hard job to do. But if you go back to pre-NAFTA and or FTA, and the Canadian wine business was going to be wiped out by the trade agreement. Well, look what we have today is a wine business. I mean, so that just shows you that it's very hard to predict. And especially it can be a bit of a leap of faith. The positives, they're not obvious at the time that you're doing it. So, but as for profits, it's a really hard call to make, because certainly there would be some sectors that would say, well, they would benefit from more protection. It's possible that profit margins would improve in some, and others, if you had to operate without NAFTA today, and your whole business model has been based on those zero tariff rates, and you're in a let's say not a big profit margin space, which most manufacturers say don't have a huge profit margin, then it could be like fatal, for that business that's been built from scratch in a world of NAFTA. And yet another company in the same space could find a way to adapt to it and adjust and so on. So this is why it's you're really asking too much for economic models to be able to go into that. And it's why I've said most of the things we'd learn would be learned in real time.
And just a really wide open question. At the end of the year, in our year-end interview with the Prime Minister, we asked him what keeps him up at night. And
really?
His answer, we did. And his answer was NAFTA.
Yeah.
So, Governor, Deputy Governor, what are in your nightmares, if you wouldn't mind me asking?
Well, I mean, I gave a whole speech on what keeps me awake at night, David, and yeah. Well, I mentioned NAFTA a couple of times in there, but it was not our number one thing, in the sense it's our biggest issue in the forecast space for sure. And so I certainly agree with the Prime Minister on that. It's still keeping us awake at night. But I was digging down a layer into the various things in our forecast and how the economy is functioning that were making us think twice about our analysis. But what's keeping you awake at night, Senior Deputy Governor?
There's one thing that you didn't mention, maybe because it was so obvious, and that's really household. That's keeping me up at night.
Yeah.
And not so much that I think it's just the vulnerability that we would face if we had a shock. There's plenty of reason to think that continued growth, the changes in macroprudential policies that we put in place will improve underwriting standards and the quality of debt. And the interest rate increases that we have will slow credit growth. We've already seen a little tick down in credit growth. Don't know if that's already a sign from our policy. It's early days, but certainly those things are all pointing in the right direction. But until we get there, I think that does leave us more vulnerable than we would have been otherwise to bad things happening.
For the record, the other things that I mentioned were cyber risk, which was, doesn't often come up in the economics context, which is why I mentioned it in Toronto. And, my old favorite is the youth participation in the labor market, which is showing some good signs lately, which I'm heartened to see.
And we're going to end on Reuters. Andrea?
Thank you. I'd like it if you could provide some color to the discussion of the policy decision. Was holding rates steady considered, and was there any concern that financial markets had gotten ahead of themselves in pricing in more hikes?
Yeah, so that's it's an interesting way to pose the question. There's no question that for us we didn't walk into this as if it was a no-brainer that it was time to move rates. There was a good debate around that. It's not that we were arguing, but that we're debating the pros and cons, et cetera. And many of the issues that we've talked about, we laid out the 4 key issues back in October that we thought we should monitor closely. And so on each of those, we had some news, and each of them gave us, encouraging news, actually. Perhaps the one we knew the least about was the one you just talked about, which is the role of debt and how sensitive is the economy to higher interest rates. Well, it takes more time to get a reading on that, especially given that people, to some degree, appear to be pulling forward their house purchases in order to execute their mortgages in advance of the new rules. So once that settles out, then we'll get a better read on that issue. And as Carolyn just mentioned, at least credit growth has moderated a little, so it shows the interest rates are beginning to affect some decisions. So that's, but the other things, like on wages, we got some good news. The labor force participation, the investment side has been quite strong, both in actual investment numbers and the indicators of investment, such as the BOSS survey, and of course the imports of machinery and equipment. So we're getting some good readings there of the ingredients of stronger supply side growth in the economy, which I think is very helpful. So our issues were helping us along, and of course the big cloud over the forecast, as well as our discussion is, well, NAFTA, how immediate, how big, lots of debate around that. And so given those uncertainties, of course, the possibility of not moving at this time was in the air. But at the same time, we say we are data dependent. And there's no question that the data on balance since October have been stronger than our base case. Not every data point, but on balance. And given that, and given that the string of positive surprises has encouraged us in the underlying narrative, feeling more confident about that outlook. It's not like you change a lot of numbers, but it just feels better, a higher quality. And in that sense, it seemed opportune. I won't comment on whether the market, reacted faster or slower than that. I just find it on balance reassuring to know the market reads the data similar to what we do. And so that's what I mean by the other side of data dependence, is that the market's reacting to the data actually before we do. And that's very helpful.
And with your focus on NAFTA today, and there are people counting how many times you've said NAFTA
Really?
And all that, of course, I'm wondering that there's a sense that policy is now tied to NAFTA headlines. Are you concerned that that volatility brings to the dollar and to rates?
So I think people will need to understand that for us, and we actually have been fairly open about that this morning, that for us it's not a matter of a binary event. We simply don't know enough about the potential consequences of a substantial change to NAFTA to be able to pre-calculate what policy should do. So I like to compare it a bit to the oil price shock. So the oil price shock was in a case where you knew exactly by how much oil prices had fallen. You could, relatively short space of time, talk to a very large number of companies in Canada who would give you clear insight into what they thought they would need to do. And so we had a very strong reading on the consequences of that shock, and we were able, therefore, to do policy in a almost preemptive way, certainly in a way that buffered the effects on the economy in advance. And so, whereas I think with NAFTA, it's more a case of, well, it's an ambiguous consequences. We've already got part of it modeled in, so we'll continue to watch that unfold, investment decisions in particular. And as on the trade front, we would monitor it and see how the fallout on the economy unfolded. And that would mean fine-tuning that policy deliberation process in real time, not doing a fancy scenario exercise in advance and having it all figured out. And so you will need the benefit of time and data to understand this as it unfolds. And so markets should not think of it as a binary event. And I'm hopeful that they appreciate the conversation we just had.
And I'm afraid we'll have to leave it there. That concludes today's press conference. Thanks, Governor, Senior Deputy Governor, and thank you all for coming. Have a great afternoon.